Welcome back, friends. Imagine this scenario. You're at a crossroads, choosing where to invest your hard-earned money. In one direction, you see an investment that promises growth. In another, you see an option with significant tax benefits. For years, the path was clear. Choose the investment that saves you the most on taxes. But what if I told you that this familiar path is no longer the safest route? In today's video, we explore a transformative shift in the investment landscape, one that challenges the conventional wisdom of letting tax considerations guide your investment decisions. Welcome to the new reality of investing without tax bias, where the merits of an investment, not just its tax perks, should determine your choice. We'll uncover why the recent changes in tax laws are reshaping the way investors should think, what this means for your portfolio, and how you can navigate this new terrain. This is more than just a story about taxes. It's about making decisions that could shape your financial future in ways you never expected. Let's begin by understanding the landscape. For years, tax-saving investments were a cornerstone of financial planning. Investors were drawn to products like ELSS, PPF, and others, not just for their potential returns, but for the tax deductions they offered under Section 80C. This strategy made sense. After all, why not reduce your tax liability while growing your wealth? But the recent budget has leveled the playing field, introducing tax parity across different asset classes. This means that the old tax-driven strategies may no longer be as effective or necessary. For instance, the removal of indexation benefits on real estate has narrowed the gap between the taxation of real estate and equity investments. Suddenly, the decision isn't just about minimizing taxes. It's about maximizing returns in a tax-neutral environment. Think about this for a moment. If tax advantages are no longer a deciding factor, how do you choose where to invest? What if the investment you've always relied on for tax savings is no longer the best choice for your long-term goals? Let's dig deeper into the implications of these changes. The traditional mindset of choosing investments based on tax efficiency has been upended. Now, more than ever, the focus must shift to the fundamentals, the intrinsic value, risk profile, and alignment with your financial goals. This isn't just a subtle shift. It's a paradigm change that requires a complete reevaluation of your investment strategy. Consider this. You're looking at a debt mutual fund that, in the past, offered significant tax benefits thanks to indexation. But now, with those benefits gone, how does it compare to other investment options? Is it still the right choice? Or should you be considering equities, real estate, or even international funds that may offer better growth prospects, albeit with different risk profiles? This is where the real challenge lies, making investment decisions based on merit, rather than being swayed by the allure of tax savings. It's a shift that forces you to think critically, to evaluate each option on its own merits, and to resist the temptation to take the easy route. And here's another layer to this story. With tax parity in place, investors need to be more strategic than ever about asset allocation. Diversification, once a buzzword, is now a necessity. But diversification isn't just about spreading your money across different asset classes. It's about understanding the risk and return dynamics of each investment and how they fit together in a cohesive portfolio. Imagine you're crafting a portfolio today. Without the crutch of tax benefits, how do you ensure that your investments are not only balanced, but also aligned with your risk tolerance and financial goals? It's a puzzle that requires careful thought, expert guidance, and a willingness to look beyond the obvious. So, where do we go from here? How do you navigate this new landscape where the old rules no longer apply? The answer lies in embracing a new approach to investing, one that prioritizes long-term growth, financial stability, and alignment with your personal goals. This means taking the time to assess your current portfolio, understanding the true potential of each investment, and being open to making changes if necessary. For example, if you've been heavily invested in tax-saving instruments that no longer offer the same benefits, it might be time to rebalance your portfolio. This could involve shifting some of your assets into equities, which, despite their volatility, offer the potential for higher returns over the long term. Or perhaps exploring international markets, where growth opportunities abound, even if they come with additional risks. It's also important to stay informed. The financial world is constantly evolving, and staying ahead of the curve requires a commitment to learning and adapting. This might mean working with a financial advisor who can provide insights and guidance, or simply dedicating time to research and staying updated on market trends. But above all, it's about making decisions with clarity and confidence. No longer can you rely solely on tax advantages to guide your investments. Instead, you must look at the bigger picture, considering factors like risk, return, time horizon, and how each investment fits into your overall financial plan. As we come to a close, one thing is clear. Investing without tax bias isn't just a new strategy. It's a smarter way to invest. By focusing on the true value of each investment, rather than being swayed by tax considerations, you can build a portfolio that is resilient, growth-oriented, and aligned with your long-term goals. This is the new reality of investing. It's a world where the merits of an investment, not just its tax perks, should guide your decisions. And while this might seem daunting at first, it's also an opportunity to invest in a way that truly reflects your values, your goals, and your vision for the future. So take this moment to reassess, to realign, and to embrace this new era of smart investing. The path ahead might be different, but with the right approach, it's one that can lead to greater success and financial security. This video was inspired by the insightful article, Invest Without Tax Bias, written by Sanket Dhanorkar, published in the Economic Times Wealth Edition. We extend our gratitude to the author for shedding light on this important topic and helping us all navigate these changes with confidence. For a one-to-one discussion with a highly experienced finance professional who always keeps your interest ahead of everything, you can write to us at info@eacapital.in, and one of our team members will get in touch with you.